Good morning. This is Japanese Economic Review Channel. Today, we review the market dynamics of yesterday, May 19, 2026. It was a day defined by a striking divergence between headline indices and the underlying strength of the Japanese market, all set against a backdrop of intensifying global geopolitical risks. Looking back at yesterday's performance, three themes dominated. Macro volatility triggered by US-Iran tensions, domestic divergence where the topics decoupled from a tech-heavy Nikkei, and emerging momentum as capital aggressively rotated into frontier sectors like space and AI. The numbers tell a story of two markets. While the NY Dow managed a rebound on May 18th, the Nasdaq remained under pressure. In Japan yesterday, the Nikkei 225 fell by 265 yen, marking its fourth straight decline. However, the Topix bucked the trend, gaining 24 points on massive trading value exceeding 10 trillion yen. The primary driver was the spike in WTI crude oil following stalled US-Iran negotiations. This fueled inflation fears and a potential Fed rate hike pivot, hammering rate-sensitive tech stocks like Seagate and Micron. While a late-day SNS post from President Trump suggesting an attack delay helped the Dow recover, the damage to tech sentiment was done. Yesterday highlighted a tale of two indices. The Nikkei was disproportionately dragged down by its heavy weighting in semiconductors. Yet, a look at market internals reveals a different reality. Over 70% of prime market stocks, 1,116 companies, actually advanced, proving the broader market's health. The Nikkei's intraday path was a struggle. It opened with a dead cat bounce, but soon succumbed to the semi-drag. By 1:03 p.m., the index hit a low of 60,256 yen. Although it trimmed some losses by the close, the persistent weakness in heavyweight tech stocks firmly capped any meaningful recovery. We saw a definitive rotation. Capital flowed out of cyclical tech and machinery, such as Keyence and Disco. In contrast, funds poured into domestic value and defensive sectors, including major banks like MUFG, insurance giants like Tokio Marine, and retail leaders such as Fast Retailing. The tech drag was palpable. Domestic semiconductor leaders, Advantest and Tokyo Electron, acted as heavy anchors on the Nikkei. This domestic weakness was a direct ripple effect of the overnight US sell-off in memory and equipment stocks triggered by global macro jitters. A bright spot yesterday was the Growth 250 index. We witnessed aggressive buying in frontier tech. Space ventures like Astroscale and drone manufacturers like ACSL posted significant gains. Investors clearly separated long-term innovation plays from short-term macro-sensitive tech. Beyond the trading floor, real-world innovation continued. Fujitsu established a new quantum hardware hub, Optum launched a comprehensive smart agriculture platform, and JT entered a joint venture for biocosmetics. These moves signal a continued commitment to high-tech infrastructure and sustainable growth. We also noted significant operational shifts: Skymark's flight optimization software, Yokohama Rubber's global factory expansion in India and Mexico, and Odakyu's new trail management solution. These updates reflect a corporate Japan focused on efficiency and global scaling, despite market volatility. In conclusion, yesterday's Nikkei drop was a statistical illusion. While global tech faced a risk-off rotation due to interest rate fears, the broader Japanese market remained exceptionally resilient. Capital is not fleeing. It is strategically rotating into the bedrock of the domestic economy. Thank you for watching the Old Japanese Fairy Tales channel. We look forward to having you with us again.